Hi, so welcome. Got a lot to try and discuss, but welcome to the live stream on the question of will interest rates come down? As you're watching, if you have any questions, please throw them in the comments and I will get back to them. If you're not on the live stream, but you're watching this later, please still throw them in the comments in the question. Let me know. What do you think? Will interest rates be coming down later in the year 2024? So I have a lot that I want to kind of cover and a little bit of time to do it. I don't want to take up a whole lot of your time. So I'm going to move fast and go into this conversation fairly quickly and move at a high pace. So, first thing I want to talk about in terms of should we expect interest rates to come down is that interest rates tend to have a really long cycle. We think of economic cycles as being short and 3 to 5 year periods of time where the economy goes up and down. We see good economies followed by bear and bad economies. And we think that this is a 3 to 5 year period. If we follow the stock market historically, it's roughly about 5 years. You see a 20% a bear market roughly once every 5 years. It recovers pretty fast. And then we have that cycle go through every 3 to 5 years. The economy as a whole, in terms of recessions, we see that same thing. We see that it tends to happen over a pretty quick period of time. It doesn't necessarily take extended periods of time to get into and out of a bad economy. We usually see those things happen again roughly every 3 to 5 years. So it tends to be fairly quick and fairly happen. But when we talk about interest rates don't have this 3 to 5 year period. They tend to have a very long interest rate cycle. And, looking at some of those numbers, as I kind of glance at my notes, peaks and troughs seem to be about 30 years apart. So from the peak to the trough seems to take about 30 years. And here are some of the numbers I found. And I have a chart I'll show you as we kind of walk through this also. So let me pull that chart up for you and share my screen with you. I didn't add a screen share, so I don't know that I can do that actually. I'll have to work on that for next time. But essentially what we saw is interest rates topped out in the early 80s. In the early 80s, we had interest rates of about 18%. If you were a home buyer at that time period, if you're watching me, you probably either were a home buyer or your parents were a home buyer. During that 80s period, interest rates were 18% in the early 80s. I have a friend of mine who used to do mortgages, and in his doing mortgages, he actually told me stories of he would come into the bank and people would be lined up at his door waiting to get in to do a mortgage because they had come down to 16%. And this is absolutely crazy. But we saw these in the early 80s. We saw these types of numbers in the early 80s. And here we are in the 2020s, and interest rates bottomed around 2010, and then they rebottomed again during COVID. So what we saw interest rates top up in the 80s and come down over a 30-year extended period of time. And over that 30-year extended period of time, they got down to zero. All right, well, that's one piece of data. But now let's look at another piece of data. Let's look at it in the opposite end. Interest rates prior to that peak in the 1800s bottomed in the 1950s. In the 1950s, they were sub 2%, early in the mid to early 50s. From 1950s to the 1980s, where they got back to 80%, we had a 30-year period. So what we see over this elongated period of time for interest rates is we see a 30-year up ramp and a 30-year down ramp to where we were. So this raises the question of, okay, well, are we just 30 years away from seeing 18% again? I don't know, maybe not. 30 years from now is a really, really long time. It may have been that 18% spike was an anomaly, and interest rates are going to be in a smaller band, not as high, not as low, over shorter periods of time. But this is kind of what we tend to see, and this is the Fed's data. Let's see if I can pull it out for you. I'm not really great at doing this. Yeah, we'll figure it out. But as we see, the Fed's data tells us that from 1955 to early 80s, we saw a 30-year period. And from the early 80s to 2010, we saw a roughly 30-year period. So that raises that kind of gives us an idea, a little bit of what's going on. So will interest rates continue to go down? Well, I think it's really important that if we want to talk about whether or not interest rates will go down, I think it's important that we first understand how the Fed works and what they're trying to actually do. And the first thing you have to understand is that the Federal Reserve doesn't actually set interest rates. They set a target rate. They set a target rate, and it's actually a target range. And what they're doing is they're not setting mortgage rates, they're setting rates for overnight lending. So how much does one bank charge to another bank to borrow money for one night? Or how much does the Federal Reserve Bank charge to the other bank, to banks, if they need to borrow money for overnight? So what might happen is a bank had a lot of withdrawals for a day, or had a lot of checks clear, or something happened and they don't have enough reserves to meet their overnight reserve rate. So they may borrow a couple $100 million or a couple $1 million just to manage until the next day, and then they'll hit their reserve rate again. It'll balance out, and instead of being one that has to borrow, there'll be one that has to lend. And these things kind of happen on a daily basis for banks. And that interest rate that they have overnight is viewed as the safest way to lend money if you're a bank. So if you have money on your books and you want to lend money, earn a little bit of interest rate, you lend it out to other banks and you get very safe money. It's going to come back. It's without any real concern. Well, the Federal Reserve doesn't set that interest rate, but they set the target for that interest rate. And right now, the target for that interest rate is 5.25% to 5.5%. So what we see is the Fed funds rate is set for 5.5%, is what people often say. But they're somewhere in that ballpark. I was looking at 5.33 was yesterday's number. I believe it was yesterday's. It was 5.33. So if the Federal Reserve is setting this overnight interest rate, the question becomes, how do we do that? Well, they do that by what they call open market operations. And there are some really good videos on YouTube about how the Fed works. You can go into those. Be cautious because there's a lot of conspiracy theories out there about the Fed. Some of them are even possibly true. We'll see. But essentially what the Fed does through these open market operations is they buy and sell really short-term U.S. treasuries, trying to manipulate the market and cause the interest rates to change to where they want to go. Think of interest rates and bond prices as a teeter-totter, and we'll come back to that analogy later. But think of interest rates and bond prices as a teeter-totter. As interest rates go up, bond prices go down. And as interest rates go down, bond prices go up. So by buying or selling bonds, they're essentially changing the price for those bonds, which affects the interest rate. So right now, as they're raising interest rates, what they're doing is they're selling bonds to make the prices go down. And as those prices for the bonds go down, people want them a little bit less, so you have to charge a higher interest rate to sell the bonds you want to sell. And that's what they're doing. They're kind of manipulating the free market for the purpose of controlling where this overnight rate of return on interest or overnight interest rate comes from for banks. So it's really important to understand they don't set the interest rate, but they try to buy and sell bonds to manipulate the interest rate. Okay. And this then raises the question is, how does this affect your mortgage? So if they're manipulating treasury bond rates, well, how does it affect your mortgage? And understand that your interest rate, when you go to the bank to get a loan, it is based off of really based off of a whole lot of different things, but two most important things to think of are risk. How much risk is that bank taking on? And opportunity cost. Opportunity cost means what can I do with that money if I don't give it to you? What other options do I have? So when we talk about risk, we're talking about what are the odds that you do not pay that money back. And that's a really important thing to think about, because with the risk of a loan, as a bank, that there are places you can go where you can get your money back, where you're not going to lose money. So lending to someone off the streets who wants to get a loan carries an amount of risk that other investments may or may not have. And we'll go into default risk is really what we're talking about. So the question is, how likely is this person going to default? So what I want you to do is I want you to put yourself right now, thinking about this, put yourself in the position of a bank, and your neighbor Bob walks into the bank, and hopefully you don't actually have a neighbor Bob. But your neighbor Bob walks into your bank and he says, I want to borrow money to buy a home. The first thing we know is there is some chance that Bob is going to default. Maybe he's a good borrower and he has great risks, but maybe he's going to get sick. Maybe he's going to lose his job. Maybe something's going to happen, and over the next 15 or 30 years, however long time period he wants, something happens that causes him to not be able to finish paying off the loan. Right? So there's a chance that he defaults. But you also know that you can take the same money and you can give it to the U.S. government and buy U.S. treasuries and be all but guaranteed that you'll get that money back. So the government, and I know some of you will say, well, what if the government defaults? Well, the government doesn't necessarily default. The way the U.S. government defaults is by printing more money. So the government's going to pay you back. If you give them $100,000, then when that loan matures, they're going to give you $100,000. But the question is, how much money have they printed and how have they caused inflation so that 100,000 isn't worth as much? That's where the risk is in treasuries. But you know you're going to at least get your principal back if you give it to the government. So you know that there's a chance that Bob defaults, and there's really no chance you don't get your money back from the U.S. government. So you have to earn more from Bob than you would earn on interest from the U.S. government. So if treasuries are at the 5.5% right now, then to give a mortgage to Bob, I have to give it to him for maybe 6. Or what we're seeing is that the desire for the Fed funds rate is at 5.5, and we're seeing interest rates that went back over, I think I just saw this morning, they went back over 7. So we're seeing about a 2%, maybe a 1.5 to 2% spread. And this is because as a bank, you have to be compensated for taking on this extra risk. You have to take into account the fact that I could put my money here and lose nothing, or I could put my money here and know that there's a chance I'm going to lose my money. Maybe that's a 5% chance, maybe it's a 1% chance, but it's still there. And if you're a bank giving out, you're a bank doing 1,000 loans a day, then you know that maybe 50 of those loans are going to go bad. Whereas if I give all of it to the federal government, then I don't lose any of it. So you have to be compensated for that. The second aspect of it, and I touched on it a little bit here, is opportunity cost. So if I give Bob the money, I can't use that money for anything else now. I'm out. It's gone. So opportunity cost means I could potentially use that money and put it somewhere else, but now it's gone. So maybe I'm willing to take on a little bit more risk. Well, I could give it to Bob, or I could buy very big, very stable stocks that pay dividends and maybe earn a higher rate back because a better dividend, maybe get a little bit of accumulation or growth. And as a bank, when they set interest rates, they have to take these two things plus a lot more into account. So when you're going into the bank fighting for a mortgage and you want the lowest rate, you're not just fighting the bank for the mortgage, you're fighting the Federal Reserve, you're fighting the bond market, you're fighting the stock market, you're fighting all of these different options where they can put their money. And I know banks can't technically invest some of their money in more aggressive things, and I get it, but we're talking conceptually here. So conceptually speaking, you're fighting against all these other places the money could go. And right now, that money could go to a lot of different places, maintain the same amount of risk for a higher rate than it could 2 years ago. So now we're paying 7 instead of 3. So the question then becomes, it kind of morphs. And as you can see, as I was writing my outlines for these, the questions kind of cause themselves. Well, okay, now I understand why my rates are high as they are. When will they come down, or will they? And, again, to answer this question, I think we need to understand a little bit more in regards to the Federal Reserve, and how, to answer the question of what would cause the Federal Reserve, well, we have to answer. Sorry, got a little tongue-tied there. I usually don't read notes when I talk. I usually just kind of do it off memory, but I wrote these up today. So kind of when I look over to see where I'm at, I lose my train of thought. So, but it asks the question of then, will rates come down? And then to answer that question, we have to understand what might cause the Federal Reserve to decide to lower rates again. So the Federal Reserve doesn't want to lower rates right now because they want to maintain inflation. And if they want to maintain lower inflation, they don't want a zero inflation, but they do want to maintain lower inflation than we've had. Then the first thing we have to understand is we have to have a lower inflation, but not just lower inflation for one monthly reading. We need to have lower inflation for an extended period of time. So the Fed's mandate, if you watch the news, they're going to say what the Fed wants to do is the Fed wants to get to 2%. The Fed doesn't want to get to 2%. The Fed wants to get to 2% for an extended period of time. So if the Fed wants to get to 2% for an extended period of time, that means we have to see an extended average 2%. And if we know that we're coming out of a period of time where what we've seen, in the past 5 years was close to zero inflation, and now we're seeing numbers up in the 9, 8, 10 range for a period of time. They want to take this long extended period of time and they want it to average out to 2%. I don't really know what time period they're looking for and what they'll decide upon, but I know that they're not going to lower rates just because we got one reading at or under even 2%. But I do know that they are going to lower rates when we see an extended period of time of inflation under 2%. And that's because the opposite of inflation is deflation. And what deflation is deflation is when prices go down, and the Fed is terrorized of deflation. They look at deflation as the cause for the Great Depression. So they want to fend that off, and they don't want to get into deflationary period. So they want to be at 2% average for an extended period of time before they will even contemplate lowering interest rates. That's their first part of what they're told to do. The second part of what they're told to do is to maintain unemployment, at a low rate. Now, in this case, what they're going to be looking for is they're going to be looking for the number that I'm hearing from everyone is 4.2%. When unemployment gets to 4.2%, then interest rate cuts will be on the table. Doesn't mean they'll do it, but that's when they'll be on the table. Right now, unemployment is at about 3.9. In fact, I was looking at the number. I pulled it up just to make sure. 3.9 unemployment. So we have a little bit of room to go. A 0.3% jump in unemployment is in a 330 million person country is a good jump of employment. Now, they're not all workers, but nonetheless, that's a big jump of unemployment to go from 3.9 to 4.2. If that happens, the Fed might be willing to then lower rates. And if these two things happen, the very first thing we do before they ever lower rates is they will say, we're going to lower rates. The Fed will talk about lowering rates before they ever lower rates, because the truth of the matter is they don't need to lower rates. They just need to make us think they're going to lower rates. Because if they talk about lowering rates, then the economy will start to heat up, because people will think, okay, we might have rate cuts coming. Let's hire, let's spend, let's ramp up, let's build new factories. Let's do all these things that we can do when rates get lower, because they might be coming. And in fact, everything that we have seen in the economy this year is really this concept and idea, because they put out a chart last year saying that they thought there would be rate drops this year. And every time we see any kind of major number come out that shows the economy slowing down, the market goes up. And every time they see a major number come out from anywhere that shows the economy speeding up and going good, then we see the markets go down, because the markets are anticipating this rate cut. And every time a good, strong economy is predicted, then the chances of the rate cut go away. And every time something is wrong in the economy, the chances of the rate cuts come back. So the Fed, by just telling people, look, we think we're going to cut rates towards the end of the year in 2024, they're telling people, look at these numbers. If they're bad, get excited. And if they're good, don't get excited for rate cuts. So then this leads me to the next point I want to talk about, which is, what would cause inflation to slow to a 2% rate? We're still well in the threes, and threes is not the goal. So the Fed's not going to stop what they're doing until we get to 2. So I think that if you just look at the numbers we see today, if you had to guess, I would say there's a better likelihood of a rate increase than a rate cut. But those numbers can change at any time. So I'm not saying that's what's happening. It's just based on what we're at. So the question becomes now, we'll talk about, is what would cause inflation to drop below or to the 2% prolonged period of time? And the answers to this question are complex. There's a lot of things that may cause this, but understanding that inflation is essentially a measure of the strength of the US dollar versus the items we buy is key to this. This is really the thing that I think a lot of people miss when they talk about inflation. When we talk about inflation, what we're talking about is the dollar getting weaker compared to the cost of other items. And when we talk about deflation, prices going down, we're talking about the dollar being stronger. So in other words, I thought this was a great analogy. In other words, when bread prices go up in price, It's because people are valuing that bread more than they're valuing the US dollar, at least in comparison to the way they valued those two items a month ago. Think about it this way. If bread prices go up, it's because people are willing to give more dollars for the same amount of bread. So they're placing more value now on that bread and less value on those green pieces of paper. It's a teeter-totter. Remember I said earlier, think about it as a teeter-totter. This is a great way to think about this. As the price of goods go up, the dollar goes down. I should use like a pencil, right? As the price of goods go up, the value of the dollar is going down. As the price of goods goes down, the value of the dollar is going up. So what's going to cause the U.S. dollar, the inflation to slow down? We need to raise. This is the price of goods. We need to raise the price of a dollar. If the price of the dollar and the value of the dollar goes up, and the way people want the dollar goes up, then the value of goods and the prices of goods will go down. So the primary way that we slow down inflation is we increase the value of the dollar. So let's talk a little bit about this value of the dollar concept. Right now, a lot of people want the US dollar. You might say, we've seen so much inflation. But the reason we haven't seen hyperinflation is because the world still has a lot of demand for the US dollar. And as long as there's a lot of demand for the US dollar, there will be a degree of price controls. Now, look, by no means have I enjoyed I got 4 kids. My cost of shopping has gone for groceries has gone from $600 to about $1,000. They're getting a little bit older, so some of that is preteens in the way they eat. But my cost for shopping has gone up insanely just to buy them food. So it's not a good thing that we see these prices go up, but the demand for the dollar is a good thing. It's still there. It is still there. And as long as we have demand for the dollar, then we will be in a position where our inflation will be controlled. Not that we enjoy 9%, but think about it this way: if we weren't the reserve currency and all the nations in the world didn't want to still hold US dollars, and I know the talk about de-dollarization, and I've got that in my notes later on, maybe we'll hit on it, but I'll talk about countries coming off the reserve currency of the dollar. It's not happening yet, and maybe happening slowly, but it's really not happening yet. But as long as they want them, it'll help to maintain and control the inflation rate and what we do with our money. So the best way to hold off inflation is to strengthen the dollar. And the Fed's policy right now is doing that. Right? The Fed's policy right now is doing that. By raising the interest rates, they're making people want to buy U.S. Treasuries. And when people buy U.S. Treasuries, they're basically holding the U.S. dollar. All right? So the problem we have, though, the opposite side of that is the problem we have on that is that our government policies do not support a strong dollar. Our government policies actively weaken our dollar. So again, let's think supply and demand. The more supply of something there is, the more you drive down the price of that thing. So I like to use the example of donuts, because if you don't like donuts, there's something wrong with you. So I like to use the example of donuts. I love donuts, or bacon is even better, but donuts works good. If I have a box of donuts and I have 12 donuts in my box, and you come to me and say, may I have one? I'm probably going to be like, yeah, I can't eat them all. Have a donut. And if I have 5 donuts in my box, you might come to me and say, you know what? I wanted to take some home to the kids. So, give me $3 and I'll give you a donut. But if you come to me and I'm hungry and I have 1 donut, because my supply is so much lower, and you say, I got $3, you want a donut? I'll buy your donut off you. I'm going to say, no, I plan on eating this donut, but you give me $5 and maybe it's worth it for me to now go just give you the donut and go buy a new one, or maybe $10. Right? So the more donuts I have, the less I need donuts. And in economics, what this is called is the law of diminishing returns. So having 1 donut is valuable to me. Having 2 donuts, I can eat 2 donuts. Sad to say, but I can eat 2 donuts. 3 donuts, maybe I'll eat 2 now and have 1 later today. So maybe I want that 3rd. 4 donuts, nah, I don't really need a 4th. A 5th donut, I really don't need. A 6th one, I don't even want. So there's value that I assign to each of those donuts based on how many other donuts I have. And the US dollar is this way too. So based on how much money I have, will determine how valuable that next dollar I get is. Here's a really great example of that you will understand. If you have money in your savings account, you have money fully funded in your retirement account, all of your bills are paid, and you're doing really good, and you have a pantry that's full of food, and you have real no financial needs, and your boss comes to you and says, I really need you to work a little bit of overtime tonight. It's a lot easier to say no. I'm going to go home and spend it with my kids are more important to me. But if you have less money, that same overtime offer becomes more valuable. So each dollar you add to your stack of dollars becomes less valuable than the last. And this is the thing to think about when it comes to our government spending policies. As they continue to add money to the stack of money that's available in our economy, all these places that want our US dollar are going to start thinking, I really don't need more US dollars. I have enough. I want other things. So how does this affect you? Well, it affects you because we see the stock market run up like we saw since the 2020s. The government sent so much money out to everyone who had kids, especially, but they sent so much money out during those periods of time that people were like, I have enough money in the bank. I'm going to throw it in the stock market. And the stock market took off, right? And it caused GameStop type things going on. So every dollar you get becomes less valuable. So you're willing to take more risk. So as there's more money in the system and more money out there, the value of our dollar goes down. And if the value of our dollar goes down, the price of our goods goes up. So every time the government creates another spending bill, every time the government spends and lives in a deficit, we end up seeing higher cost for goods. And if I'm the Federal Reserve, I'm frustrated as all get out because I'm trying here to slow inflation, and everything our government is doing is to speed up inflation. So by manipulating the supply of US dollars through spending and policy, they're making the value of our dollar either go up or down. Right? And this is really vital, and it's a really important concept to understand. So when we look at what the Fed does when they raise taxes, right? When the Fed raises taxes, they take money, or the DC, I'm sorry, not the Fed. When the government raises taxes, they take money out of the system. That money coming out of the system is going to slow the economy down, but it's also going to slow down inflation, and it's going to strengthen the US dollar. So you pull dollars out of the system, there's less dollars in the economy. More people want their dollars. More people want their dollars. Stock prices go down because they don't want stocks, they want dollars. Food prices go down because they don't want food, they want dollars. And as you raise taxes, these things all happen, right? So this is why Republicans will always say raising taxes will cause a recession, because it brings down prices of goods, right? On the flip side of things, cutting taxes will cause prices of goods to go up. Spending does the same thing too. When the government spends, they drive up prices, because as they're spending, they're putting more money into the system, and that money is now less valuable, and people want things more than they want the money. So as the government spends and runs deficit spending, then our government is stimulating up the economy. When our government runs surplus and spends less than it brings in, it's going to slow down the economy, and it's going to make it slower. So we have this problem here of what do we do in relation to our spending and our Fed, and how do they work together? Because we've got a government in DC that wants to spend to buy votes. I don't care which party you are, this is what they do. And we've got a Fed that wants to slow down inflation. So they're working against each other in a little bit. So what needs to happen to slow down inflation? Well, the government needs to balance the budget. It needs to happen. We need to figure out a balanced budget to really slow down inflation. Now, there's some other levers and mechanisms we can do for the Fed to hit that 2% target, but to really slow down inflation and get it under control, at some point we have to balance our budget. And this is actually what Robert Maynard Keynes, the founder of Keynesian economics, says. We talk about Keynesian economics, and I'm pretty conservative, so I kind of tend to make fun of Keynesians, because they tend to have a spend mentality, just spend, spend, spend. But that's only half the problem. In reality, what he argued for was two cycles. There's two cycles in an economic cycle that he really looked at. He looked at the boom cycle and the bust cycle, the growth and the recession cycle. So as the growth cycle is happening, what he argued we ought to be doing is he argued that during periods of growth, tax rates should go up, government spending should go down, creating a surplus. So tax rates go up, government spending goes down. Both of those levers are taking money out of the system, slowing down the economic growth and controlling inflation. Then he said, on the opposite end, during bad economic periods, we want to lower interest rates and raise government spending. Lowering interest rates keeps money in your pocket. Raising government spending puts more money in your pocket. And during bad economic times, that takes money out of the treasury and puts it into people's hands so they spend it more. It's inflationary, and it causes the economy to grow again. So Keynes actually argued that there's two main cycles, and there's four, but really he boiled it down to two main cycles. And during those two main cycles, you want to try and take all the booms and busts out and make little waves. So instead of riding a giant roller coaster, we're going to ride a kiddie roller coaster. We're going to have ups, we're going to have downs, but we're not going to have Great Depressions, and we're not going to have Roaring 20s. So the problem with this is that the government never does that first part, right? We have people in Congress that are hired based on how much money they bring back to the area they represent. So they're hired based on how much spending they can get the government to do. And every 2 years, our Congress comes back and they run on saying, I brought X amount of $1 million back to my district. I helped keep these jobs by getting this funding. And what they're doing is they're saying, we bought your votes, but we're not helping the economy out. We're not doing what we need to be doing to secure the dollar, and I'm causing inflation, but I got your vote. And this raises a major problem, because what we need to be doing is we need to be shifting kind of a little bit between these two. And I don't think we can. A lot of people who are anti-Keynesian will say that it's impossible to predict where the market's going. I think they're right. But the truth of the matter is we have never even tried it to know. We've never tried to really do what he said to know if it would work. I don't think it would work, but if we could do it right, it would work. I do think he's right there. So, and truth of the matter is, look at this. Even the most conservative president we've had in the last 50 years ran deficits. Even the most conservative president over the last 50 years ran deficits, because no matter what we do, the government cannot get off of the drug of spending. They just can't do it. So all of this, right, all of this to say, rates are probably not coming down unless two things happen. Those two things are, we go through a period of time where the government slows spending and raises taxes, right? This is called austerity. We go through a period of austerity, then maybe we'll see inflation come down. Now, that's not going to happen in the near future. We know that for sure, but it would cause, and we know that's not going to happen because it's going to cause a generational, possibly multi-generational period of economic downturn. Now, not necessarily a Great Depression, but at least a couple generations where you're living at a lower financial level than your parents did. And that's something that's never happened in America. And I know, like houses are more expensive now than they've ever, and blah, 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 blah. The problem with houses is a total issue. It's partially caused by this, no doubt. But the problem with house prices has to do with not enough supply. It has to do with a whole lot of other things. And really, at the end of the day, the house your parents bought when they were 25 is not the same house you're trying to buy when you're 25. So there's a little bit of, we're living in a much higher standard. We don't have a lot of small starter family homes getting built anymore. They're not as around. So we would have to have a possibly multi-generational period where we live at a lower standard than our parents. Now, some things can prevent that, right? Technology, right? At the end of the day, we're not going to have less cars than my grandma and grandpa had. We're not going to have less TVs, and we're not going to have less smartphones than mom and dad had. So technology can kind of maybe we could grow ourselves out of some of that, but not all of it. And then the second thing that would have to happen is we'd have to see demand for the U.S. dollar increase, and the demand for the U.S. dollar increase is going to cause deflation, and the Fed fears deflation more than it fears inflation. So as the Fed is working to bring inflation down, they want to bring inflation down, but the last thing they want to do is, even more so than raising inflation, seeing inflation tick back up. The last thing they want to do is see deflation. They don't like deflation. I know for a fact that when Bernanke was in charge, he was a huge believer that deflation caused the Great Depression. Paulson, I'm not so sure if he's got that same fear of deflation, but he's a big Greenspan fan, and Greenspan was not willing to raise rates until it needed to happen, or lower rates until it needed to happen. Not Greenspan, before him, Volcker. That's what I mean. So the demand for the U.S. dollar, in my opinion, I don't know if this is right or not, there are three things that can cause the U.S. dollar to go up in value. And if these three things happen, then we'll see prices come back down and interest rates come back down, because they'll have to kind of balance out the deflation that higher prices would cause. So higher prices, to overcome these interest rates, we need to see higher interest rates. Maybe not higher from where they're at, but we need to keep them where they're at least. Higher interest rates compared to what we had in the past. So because again, as interest rates go up, other governments and other endowment funds and other sovereign debt funds, all these places that have real amounts of money, not just you and me amounts, but have real amounts of money, are going to want to put their money into the U.S. and they're going to want to hold U.S. dollars. And the way they do that is by buying U.S. treasuries. So as interest rates go up, they're going to want to buy more U.S. treasuries. And as they buy more U.S. treasuries, the prices of treasuries will go up. And remember, it's a teeter-totter. The price of treasuries goes up, the interest rate on them goes down. So that would drive, so higher interest rates for an extended period of time will drive interest rates back down in the long run. Seems counterintuitive, but that's really what'll work. The second thing we would need lower government spending, right? I don't think that happens, but we need to lower government spending. If we lower government spending, investors in treasuries, think foreign countries, sovereign debt funds, will be less concerned with the idea that we're going to print our way out of debt. And if they're less concerned with their idea that we'll print our way out of debt, then they're going to be more likely to want to hold our dollars. And if they're more likely to want to hold our dollars, again, what happens? The more you want it, the higher it gets, the more likely they are to buy our treasuries. Interest rates come back down. So lowering government spending. It might not even be to the point of balancing the budget. It might be just that we need to slow down a little bit on spending. Right? And then there's always a third thing. And this is kind of where you get a little on the conspiratorial side, but global uncertainty. Global uncertainty actually helps the United States of America economically. Maybe not in those moments, but during times of global uncertainty, whether it's war, whether there's an economic downturn, whether it's a disease that spreads throughout the country, investors will actually take their money and they'll want to put it in places where it's safe. And we saw this. If we go back to 2020 and we look at the sharp drop in the stock market around the beginning of March, this is why. People were scared, and it wasn't you or I doing it. It was large dollar funds. It was a lot of people with lots of money, and they sold all their stocks to put their money in cash. So a global uncertainty is something that really helps the U.S. dollar. Now, it's kind of scary because then you think as you're hiring presidents, you're thinking to yourself, are they willing to get us into wars? Are they willing to hurt other economies for the sole purpose of propping ours up? Well, it's possible. I mean, no one's put that past presidents in the past. So it is all possible. So hopefully you've learned a little bit, and I've rambled a lot, but hopefully you've learned a bit. And to kind of give you my summary, do I believe interest rates will go back down this year? No. And I'm really tentative to say that they're going to come back down next year. I don't foresee, one person I listened to, Peter Zahan, he has said multiple years, 5 or 6 years. I think he might be right. The things that could cause that to change, though, is if the economy takes a bad turn. If we start seeing bad jobs reports, bad economic growth reports, if we start seeing companies' profits go down, then we may be in a position where we start to see a recession come. And a recession will absolutely bring lower interest rates. But in reality, though, when we think about that, do we really want lower interest rates? Because if we get lower interest rates, that probably means something bad has happened. So hopefully that helps you get a little bit of an understanding of what's going on with interest rates. thank you for if you hung out this long, please drop a comment. Thank you for being a part of this live stream and watching the video on replay.